Here's what's coming up on today's show.
Beneficiary designations override your will. And people don't necessarily know that. Well, I had it in my will. Okay, but if you did not change your beneficiary designation of that beneficiary of that life insurance policy, for example, or that IRA that you have, whatever it might be, if it has beneficiary designations, that overrides what you have in a will.
Welcome to the Income for Life Show. If you're looking for some common sense retirement planning ideas and want to hear how we make the complex financial world simple, then listen up so you can learn how you can stay retired. The Income for Life Show is powered by Folds of Honor, a 501c3 nonprofit organization dedicated to providing educational scholarships to the families of America's fallen and disabled service members. Now, here are your hosts, Matt Nelson and Nick Schilling.
Welcome to the Income for Life Show, powered by Folds of Honor, with your hosts Matt and Nick on another beautiful spring day that we have going here in the Midwest. And I know, Nick, you and I talk all the time about how, boy, we can't wait for the weather to be changing so we can get out there and get a little golf going. And we managed to do that a couple of times already, and it looks like we're going to have some more good weather coming in.
It's exciting. I think it's an exciting time of year. Everything's kind of opening back up again. People are getting out and about. The weather's cooperating. It's a really fun time. And, me and the family able to get out this weekend. It's been great.
It's been a great weather-wise here in the Midwest. And we have a really neat show lined up today because we have a couple of new announcements, if you would, a couple of new things that we have online on our website at incomeforlife.org that we're going to talk about a little bit today and introduce those new features that people all across the country can take advantage of. So we're going to be discussing those today. And our main topic today that we're going to be discussing is titled, Are You Flirting with Disaster? And it's a neat topic, and we're going to go through 5 different kind of subtopics of Are You Flirting with Disaster? But we're going to really focus in on one of these 5 later on in the show that we feel is going to have the most importance for a lot of people. So today's show of Are You Flirting with Disaster is going to be really, really appealing and really neat to a lot of people, Nick, don't you think?
I like it. And we came up with these 5 from talking to clients and their typical conversations that we go through. And these are some common things that maybe people haven't updated, they haven't thought about, they're not prepared for going forward when they're thinking about retirement or investing. So these are common things that we see every day, talk about every week. And we just want to let everybody know so that you can start planning your retirement the way. And if you have questions, just give us a call. But these are common things, and I think it's going to be useful for people to hear.
Absolutely. So we're going to go through those top 5 topics there that we came up with on Are You Flirting with Disaster? And also, we have a very good question that came into the IFL mailbag out of Chicago. So we're going to go through the IFL mailbag question today at the end as well, like we normally do. But let's go ahead, Nick, and jump into the new website enhancements, the new features, the new things that we have on incomeforlife.org. Real quick, so we can make sure that people understand that these incredible opportunities are available first with them. And the first one I want to discuss is what we call the new Income for Life discovery process. And if you're on our website right now, if you're on incomeforlife.org listening to us right now on the Income for Life show, then you see that orange button in the top left-hand area, which says, Help us get to know you, the IFL discovery process. So that is what we are discussing right now. So Nick, let's talk a little bit about the benefit of this process, kind of what it is. And then if people are listening and they want to go to incomeforlife.org, when they click on that button, they'll know a little bit more about what they're able to do. So let's talk about it.
Yeah, I really like it, Matt. And as we talk about retirement in general is a process. And in order for us to kind of understand what that process is for every family and every individual, we got to start with the discovery and us being able to do that online, making it very easy for anybody across the country to log in there, fill out their information, and for us to have that there is key. But it also is about the conversation with those individuals or the family members and everybody. What the process, the discovery process is designed to do is to start that conversation. What do we want retirement to look like? Where is all of our stuff at right now? Where's our investments at? What are our goals and objectives for retirement? And we can't really start planning where we want to go until we really nail down where we are right now on the map.
Absolutely. And what we have been told from clients that have went and done this discovery process with us already on our website is they've all kind of came back and said the same thing. Boy, it's really nice just to be able to do this from home. It's really nice that I can just sit down in an evening, for example, or on a weekend and start filling this information in. And then if I have something I got to go do, I can go do it and I can come back and I can work on this again. Or if I need to go find a document, I can. So all of them have said it's nice to be able to do this at my own pace where I don't have to sit in the office with somebody that is asking us all these questions.
Yep.
And we're having to fill this information in right there with the person directly in front of us. That can kind of be intimidating to do that. They said, we can just get on there and just fill in our information at our own leisure.
You don't have to bring all your statements in and all those
You don't have
things.
to bring it all in. Exactly.
It really helps with kind of an impetus to have the conversation, and it walks you through what information is needed, and it guides you on how to have that conversation, because it's about your plan for what you want retirement to look like, and then putting down all the statistics of where your stuff's at, where all your documents are, and it really helps facilitate that idea sharing, that conversation and dialogue amongst family members. And it's a document that you can keep for your own safekeeping so that everybody knows where everything is at. And then it's a document that you can share with your trusted advisors.
Absolutely.
So that everybody knows.
And the idea is that obviously, just like we talk about here on the Income for Life show all the time, is in order to do a comprehensive plan, or in order to allow us to give our advice to you of what we feel like you should be doing when it comes to retirement planning, we need to kind of know where you are. We need to know what you have, where you're at, what you're doing, what your goals are, things like this. So the idea of gathering this information is nothing new to anybody. If you go sit down with somebody, they are always going to have something that they give you to fill out, to complete, or they help you complete when it comes to where you're sitting on your financial snapshot. Well, our process is exactly that, but we allow you to do that on your time, and you can fill out that from the privacy of your own home on an unbelievably secure website. If you click on that orange button, you have to attest to things. You have to understand that this is how it is security-wise, and then as you're filling your information in, you sign it at the end. It is an unbelievable secure process that you can then just print it, keep it, give a copy to your kids, whatever you want to do, put in that safe deposit box. And then that will also allow us here at Income for Life to be able to review that with you whenever you have it done.
We talk in general on this podcast and on this show about investing and retirement planning. But in order for us to talk specifically, to actually give advice to individual families and clients, we need that baseline information. And this is the start of that process. And I like how easy and convenient it is. People can start it and stop it as they want. You can take your time. But once you have all the information there, it's a great usable document for us and for you and your family members to have forever.
And it's really simple. So if you are listening right now on some of our podcast affiliates, such as Spotify or Stitcher or Apple Podcasts, and you're saying, wow, that's something I may want to go take a look at, then go ahead and visit us at incomeforlife.org. And it is in the top left-hand side of every page. It's an orange button. It's the only orange button on our page. So you click on that and you'll be able to see exactly what we're talking about. Now, if you're listening to us right now on incomeforlife.org, then you may be seeing it right now. If you just look up in the top left, you'll see that orange button. Give it a click, check it out, see what you think. And it's just like Nick just said, like you just said, it's the beginning of our discovery process to help you out.
It's an exercise worth doing. Even if you've done it before, update it. If you haven't done it, then it's a great exercise and dialogue to go through.
Absolutely. Now, the second announcement that we want to discuss today here on the Income for Life show is a link that is directly on our homepage at incomeforlife.org. That is a new banner link where we are discussing the 3.1% rate on a multi-year product. And this sort of a product is not only an amazing type of a product that is available to anyone that has that CD money that's only earning about a 0.2% or less than a 1%, where you can get up to a 3.1. but you can actually enroll with this product online directly through our website, and that is amazing.
Yeah, it's exciting. We typically talk process on this show, the process of thinking about it and transitioning into retirement. We don't really talk specific product, but in this circumstance, one, we want to make sure that people are aware that there are other options out there for their savings and their retirement plannings that are offering better than bank and bond rates out there, so people can take a look and see. And then the process of enrolling in those, of acquiring those products, is as simple as anything that's out there. You just click on our website, it will walk you through the process, and you can start to take advantage of some of these rates that are out there in an environment where rates are really low, savers are being starved for interest and earnings, and here's some options that we can put out there that we're excited about and you can take advantage of at your own home.
And it's such a fantastic website link. If you go to incomeforlife.org and you click on that up to 3.1% banner that is on our website, not only can you enroll in that plan right there very easily, very simple, but you also have online and in-person support all the way through that as well. So you're not completely on your own. There will obviously be us available and our team available to help you navigate through that if you need us. But also what's really, really neat in that link is that down below, you will even see the most recent 1-year treasury rates, 4-year treasury rates, 7-year CDs, whatever it might be. There's a lot of information down below that you can then see how the current economic environment on the bank side or the treasury side, what those rates look like compared to this opportunity of up to 3.1%. Because Nick, you and I talk about it all the time. CD rates right now are so bad, we call it losing your money safely because that money doesn't even keep up with inflation. So this sort of an opportunity is perfect for people that like the idea of CDs, want to have a guaranteed rate of return, but they're scared to put money in the bank because the rates are so bad.
Correct.
This is an unbelievable opportunity for those people.
All we want to do is give people options. Lots of times it's the easiest, most convenient thing to just go to your local bank or wherever that's at and keep rolling over CDs, even though the rates aren't great. We got to be able to show people what other options are out there, what other alternatives there are to be able to earn some interest before retirement or in retirement, and what's competitive. And this is very, very competitive.
And ironically, as we're going to be discussing with our topic later on in our show here that is titled, Are You Flirting with Disaster? We're going to be discussing a little bit how people mix up their retirement planning and assets with, for example, stocks and bonds. Everybody hears that term, stocks and bonds. And how something like this plan that we're talking about with the 3.1% very well may have an opportunity in that mix as well. So it ties in very well. So the timing is perfect for this sort of a plan with up to 3.1% annual return rate in correlation with how the current structure of a typical stocks and bonds mentality fits in.
Our current environment is historically unique. We then have to find unique opportunities and alternatives to help us reach our goals and objectives in these unique environments.
Absolutely. So before we jump into that information, let's jump into our main topic of the day here, which we have titled, Are You Flirting with Disaster? And some of these topics that we're going to go through here out of these 5 ways that you might be flirting with disaster, we're going to hit a couple of them pretty quick because a lot of people understand how you can avoid flirting with disaster on a couple of them, but then there's others that we're going to dive into a little bit more. But the first that we want to discuss today is out-of-date legal documents. And a lot of people understand that. They understand they got to update that will. They got to update that trust. You got to make sure your beneficiaries are correct. But a lot of people don't, and we actually have examples of this disaster happening to people that someone's heard of.
Oh, exactly. And within this list, it's not so much for the majority of these that it's learning something new. It's reminding people of something they already know and maybe haven't done yet, or maybe need to remember I got to go update that, or I got to do it. Now's the time. Don't delay in some of these things. And legal documents, wills, trusts, estate planning, all of those things need to make sure they're as up to date as possible, because who knows what happens in life. And if you don't have that stuff taken care of, we've seen it with celebrities and musicians and people passing away at an inopportune time. And then it goes into court battles and probate and lawyers get involved and everybody's taking a cut of what you designed and designated to go to a certain thing. If it's family members or a charity or whatever it is, if you don't have your legal documents updated to what you want now, bad things can happen, or they just don't happen in the way that you want them to happen.
Absolutely. And I think what you just hit right there at the end is the key. They don't happen the way you wanted it to happen, because maybe you told the kids, right? Or maybe you told some friends, or you told whoever that this is what you wanted to have happen with part of your estate, but it wasn't written down and it wasn't in writing. If that is not documented and written in writing, then it could go any way. It could go so many different ways. And like you said, Nick, we see it all the time in the press with celebrities or musicians or whatever it might be, that you would think those people would have a team of people that would be able to help them with these things, and a lot of them don't. And then you see that it's going through the courts, or it's years later that something finally gets determined or finalized through the courts when it didn't have to be. And that same mechanism, if you would, is available to anybody listening right now. Anybody that is listening right now, regardless of your age, regardless of how big your estate is, all of these things you can do and be able to help you down the road.
Things happen when we least expect it, and making sure that these things are up to date. We can always put it off to tomorrow, and then that's when stuff's not filled out. And if you wanted to designate to give to the church and your kids aren't aware, or your financial advisor's not aware, and that's not written down someplace and up to date to what you want now, then nobody understands, and that's when people can start to bicker and argue of what they really wanted. You got to have that stuff in order and as up to date as possible.
Absolutely. So the first one, again, is out-of-date legal documents. If you haven't done that, make sure that you take care of it. If you have questions, of course, you can give us a call and we can help you with that and be able to try to match up with what you want to do with your estate. Out-of-date legal documents is flirting with disaster, number one. Number two, incorrect beneficiary designations. Boy, we see this all the time.
And it's very similar to the other one, but this one's more specific because you got a bunch of different investments and products out there that you got to make sure for each one of those things, the beneficiaries are up to date. And life happens, things change, divorces happen, other things change of what you want to do, and you got to make sure that those are continually up to date.
We hear it all the time where, an in-law became an outlaw, or whatever the scenario might be. My daughter got divorced, or somebody passed away, or whatever it might be. And then as you get older, your family becomes bigger and bigger, and you want to add on more beneficiaries.
Great point.
Because you have a new grandson, things like that. Some of those things get missed. And then down the road, you're like, oh, I did not add that, or I did not take off that person, whatever it might be. So this is a common, if you would, we see it all the time. This is a common disaster, if you would, that we see quite a bit.
Correct. It's, you got to take advantage of your wills, trusts, power of attorneys, all those legal documents, but then each of your insurance policies, your IRAs, your other things, you got to designate beneficiaries for those as well to make that process easier and keep those as up to date as possible.
And what a lot of people don't understand, Nick, is that beneficiary designations, if you have a product that has a beneficiary designation, beneficiary designations override your will. And people don't necessarily know that. Well, I had it in my will. Okay, but if you did not change your beneficiary designation of that beneficiary of that life insurance policy, for example, or that IRA that you have, whatever it might be, if it has beneficiary designations, that overrides what you have in a will.
Correct. And it's because it's a contract with that individual life insurance carrier, and they have to fulfill their contract. So if your beneficiaries don't match your legal documents or vice versa, it's making sure they're both up to date in tandem so that everything works the way you want it to. And then I know it's a lot, but that's where having some trusted advisors and some people that you can help walk you through all of this stuff that know where all your stuff's at, vis-a-vis the discovery document that we talked about before. When we got everything laid out, then we can have reminders in there to make sure that we're updating everything as needed.
And I've heard it so many times, Nick, and I know you have as well, whenever there is a life change or someone passes away or whatever it might be, and they say, well, I have it in my will that money is supposed to go to so-and-so. Okay, but did you change that on your life insurance policy? Because your life insurance policy was not set up that way. Oh, I never changed my beneficiaries of my life insurance policy. I just changed my trust or my will or whatever the scenario might be. So think of that as you're going along, everyone, as you're listening, because that incorrect beneficiary designations could indeed have a factor on how you want to proceed. Now, Nick, let's jump into the third topic of Are You Flirting with Disaster? And we call it the tax time bomb. Talk a little bit about this one, Nick, because an overwhelming majority of investments are tax-deferred accounts.
Correct.
So that can have an amazing effect.
Correct. And we've talked about this on other shows. So it's basically, are we understanding where our current tax rates are, how the IRS looks at where all of our accounts are, taxable, tax-deferred, and then are we set up the most opportune to take advantage of where our current tax rates are, where our future tax rates are, and not have something happen where we have a bunch of taxable things coming. All of a sudden you turn on income. The government requires you to start taking RMDs. That then ups your tax bracket and you got to pay a bigger tax bill than you expected. It's just starting to plan how the government looks at all of your accounts in aggregate and starting to set up the best tax situation for you. We don't want to let the tax tail wag the dog when we're investing, but it's something that we need to look at to make sure we're not putting ourselves in not perfect, not inopportune situations when it comes to taxes ongoing.
And that is a structure or a process that is always changing. The government's always changing the tax brackets. They're always changing different things with the state or how much you can do here, what you can do there. So it's always a moving target.
It's an annual conversation.
Not only before you retire, but every year while you're in retirement, that can always be moving around. So you have to be able to stay on top of that and have somebody that can actually walk you through not only the initial setup, but the potential future changes. And that's what we can, of course, do our best here at Income for Life to do that. If you have a strong accountant, they can help you with that as well. If you have an estate attorney that is up to date, they can do that as well. So you have a bunch of people in your retirement bubble that can absolutely help you with this, because you're not going to get out of taxes. It's either you're going to pay them now or you're going to pay them later. Some people say, well, I converted my money to a Roth. Okay, you didn't get out of taxes. You just paid them up front.
Correct.
So you're still going to have that. And
But there's no reason to pay extra.
Absolutely.
Just for not planning forward or taking advantage of a certain time that happens where you can maybe convert some stuff now or change the tax status of different things that then sets it up better for the long run for your beneficiaries, all that kind of stuff.
And that is a simple conversation to have on an annual basis, just to do a checkup.
Correct.
Just a financial checkup to see kind of how things are moving forward. And it is something that a lot of people just forget to do. So the tax time bomb is a big one. The fourth of Are You Flirting with Disaster topic is not having a plan for long-term care expenses. And there could be a wide variety of reasons why someone doesn't have a long-term care policy. That is not what we're talking about right now. We're talking about a plan for those long-term care expenses. So whenever we say that, we don't automatically mean long-term care insurance. It's different, but it could mean that. It absolutely could, but it doesn't necessarily mean that that's exactly how it goes, because there could be underwriting challenges. There could be financial challenges. There's a lot of moving parts inside of a long-term care policy that some people don't qualify for. But that doesn't mean that you cannot plan in the event that that were to happen, because that's one of the biggest, if not the biggest expenses a retiree could have.
Exactly. And those expenses aren't getting cheaper.
No, they're not.
They're only increasing. And it's more and more likely, because we're living longer, that we're actually going to have to utilize those things. If we don't have the family set up to where you can be taken care of by family members if they're away or you just don't have any, and even those family members are going to need support. So you're going to need to figure out how those people are going to be able to utilize some money to help you, if they're even taking care of you, in retirement. And then if you're having to use assisted living facilities or nursing home facilities, those costs are rising exponentially. And we have to have a plan. It might be, if you're available, to have some sort of long-term care insurance or have some riders on some other policies that you've already qualified for. But we also have a plan of attack of how the government's going to start to look at your assets and start to bleed those to pay for that before you can start to qualify for different programs like Medicaid that will then start to take over some of these things. So it has to be a very forward-looking plan, because those expenses aren't getting cheaper, they're not going away, and it's more and more likely that all of us will probably need it at some point in our lives. So we got to start to plan for that as early as possible and as frequently as possible as to where things are in your investment and your retirement world.
And Nick, you and I had one of our Income for Life shows several weeks ago where we really hit on this topic very hard. It was a show called The Conversation No One Wants to Have. And if you're listening right now on the Income for Life website at incomeforlife.org, you can go back and listen to that show, because we really dive into the conversation no one wants to have when it comes to end of life, if you would, or end stage sort of planning. And long-term care is one of those, because long-term care is something that often is kind of pushed down the road. We'll figure it out later. We'll do it later. We'll figure it out later. Because it's a conversation that a lot of people don't want to have with their loved ones. So it's something that you just have to do.
Correct.
You have to plan for it. You have to figure out where those assets will come from, whether that is an insurance policy or, like you said, Nick, a rider on another product, whatever it might be. You need to have at least some sort of a plan for that potential expense.
And if you don't have a plan, the government has a plan for you.
They sure do.
They will use your assets and bleed you down in order to pay for all this stuff. And if you want those things to go to other utility, beneficiaries, other things, we got to have a plan to protect those assets, or have a plan of how they're going to get used and which accounts are going to get touched first and utilized to pay these expenses. It's a big deal, and it's a big deal for so many people. And if you don't have a plan, it's going to hit you either way.
Absolutely.
Listen closely, because there's a new financial tool that you need to know about. It's being described as the CD Buster. Every year, scores of people lock their money up in CDs that pay less than 1%. It's a great way to lose money safely, because you can't keep up with inflation, and that spells disaster for a retiree. So the Income for Life team is excited to announce a new multi-year guaranteed annuity that pays up to 3.1% annually and can be purchased online. It's never been easier to get this kind of return on your money, and it can be done from your smartphone or computer in just minutes. This opportunity is insured dollar for dollar, is available in 4-year or 6-year lengths, and you even get 5% free withdrawals if you need to take money out. CDs can't do that. To find out more and to get this guaranteed annuity online right now, just go to incomeforlife.org and click on the banner, or check out the link in the description of today's show.
What we are going to do now, Nick, is like we talked about at the beginning of the show here on the Income for Life show, again, powered by Folds of Honor, we want to really spend a little bit more time on number 5 in our topic today of Are You Flirting with Disaster? And as we said earlier, we were going to hit the first 4 a little bit quickly. I mean, we spent some pretty good time on going through these, but this last one that we want to discuss really does have not only a lot of moving parts, but it has changed so much over the recent years. And it's a term and a topic that so many people have heard before, but have not necessarily made the appropriate adjustments to make it work correctly. And it is the classic 60-40 portfolio. And what this is as everybody understands, and Nick, I know you're going to dive into some stats that you found that are really going to discuss this a little bit more, but you often hear people that are approaching retirement and they talk about how they have stocks and bonds. They have stocks and bonds, right? They have a 60-40 portfolio of 60% risk, 40% safe, things like that. That is the traditional 60-40 portfolio. And that is probably one of the biggest risks right now in flirting with disaster, as we're discussing, given today's economic environment. So let's talk about it.
Exactly. And I think it's exactly what you just said right there at the end, Matt. The other 4 are stable things, legal documents, beneficiaries, taxes, long-term care. Those are things that are there forever. We have to make sure those things are taken care of. This conversation that we want to have right now is unique because of the environment that we're in right now. And we want to talk about the current environment, how it's changed from the way people used to do this in the past, and how we need to think about this unique environment and how we need to change it. The classic 60-40 portfolio, as we've talked about before, Matt, most advisors, when you start to get into retirement, we've talked about the transition mentally into retirement, the transition of where your income's going to come from, and then the transition of how am I going to invest for the 25 or 30 years in retirement that we're going to have. And one of the ways that many advisors have used in the past is kind of what they call the classic 60-40 portfolio. 60% of the money in stocks, equities, so that it keeps up with inflation and gets those returns that we're looking for, and then 40% in bonds or safety. And that has worked really for the last 50 years.
And you hear, let me jump in right there real quick. People use that phrase all the time, even more so than saying I'm 60-40. No, they usually say I'm in stocks and bonds. You hear it all the time. Yeah, I got my money in stocks and bonds, stocks and bonds, stocks and bonds. So whenever you hear that term, that's what you're talking about on this 60-40 split of stocks and bonds.
Correct. And typically, the younger we are, that ratio is typically a little bit higher to stocks or equities and lower on the bond side. We have more time on our hands, so we can take a little bit more risk and volatility. And as we creep towards retirement, that starts to converge. A little bit less stocks, a little bit more safety or bonds. And once we stabilize into that retirement, many advisors have used this 60-40 diversification to kind of balance out a little bit more stocks to grow and keep up with inflation, but having that safety of bonds in there to stabilize your portfolio, because we've talked about it in the past, Matt, losses in retirement hurt a lot more than gains help. So this portfolio, this allocation of stocks and bonds has worked literally for the past 5 decades. And I got some stats.
These are going to be interesting.
For how this portfolio that so many advisors for decades and decades have utilized, and it worked. But just because it's worked in the past, and I'll walk through some of the stats, doesn't mean it's going to work going forward.
And that's interesting right there before you jump into your stats, Nick, is because this process, this way, this 60-40 stocks, bonds, like you're going to dive into these numbers, has worked for several past decades.
Correct.
It's just we are today in an economic environment that is unprecedented compared to the way it used to be. And so you're going to have to make some adjustments given how it is moving forward compared to the numbers of the past 50 years.
And before I dig into the kind of statistics that talk about this, when we talk about that it's different now, what we're saying is not that stocks and bonds are different, but the role of bonds in this 60-40 portfolio, and we've talked about it on other shows, Matt, of where interest rates are right now are historically low. So we can't earn the same rate of interest that we have previously, not even close, and we'll get into some of the statistics. And then since we're not earning that same rate of interest, we're having to then creep up more on the equity side and take more risk in order to earn the returns to have a stable retirement portfolio going forward. So for the past 5 decades, the past 50 years, this standard 60% in U.S. equities, kind of in general, it depends on all the individual investments, but this is kind of generically U.S., let's say S&P 500 type investment, and then 40% in bonds. Over the past 50 years, it has grown over 7,000%.
7,000% over the past 50 years. With
an average of almost 10.7% average return for this portfolio over the past 50 years. That's amazing. You couldn't ask for anything better than that on a go-forward basis. It's one time, this portfolio, this stable 60-40 portfolio in the past 50 years, only one time has it lost 20% or more. So that
one time
in the past 50 years. So that's where losses hurt way more than gains help. This portfolio has been that stabilizing force for many retirees for decades.
Which is why so many people over the past 50 years have used this model.
Correct. You're using it in your 401k right now, or advisors that are investing you are using this same thing. It's only fell more than 20% once in the last market crash, but it's gained 20% or more in the last 50 years 10 times.
10 times.
So it's done what it's wanted to do. It has risen when times are good, and it's stabilized when times got really bad. But the key difference is in those past 50 years, the average 10-year yield, the average, we'll just use that as the benchmark, the average interest rate on these things as we look at it was 6.2%.
And when you talk about the 6.2% and you talk about the 10-year yield on those, tell us a little bit more about what you're talking about when you're talking about that of the 60-40 split.
So we're talking about the 40%.
The 40.
We're talking about not the gain of stocks. We're talking about the interest rate on the bonds or the safe money that you have. So you
the bonds, the CDs, the things like that.
That kind of stuff. The average interest rate over the past 50 years has been 6.2%. Interest rates over the last 50 years have been falling, but they've been pretty stable up until the last about 18 months when we've been in this pandemic and keep continuing to push. But now we're not earning, and we've talked about this on many shows before, of this kind of war against savers and retirees. As everybody's aware, you can't go to the bank. You can't get a treasury bond and earn 6.2% anymore.
I got an interesting story right there, Nick, because I was driving down the interstate last week, and there's billboards all over as you drive down the interstate. One of them was of a bank that was bragging on their billboard that you can earn up to a 1.9% return on your money.
Correct.
And they're so proud of that, they put it on a billboard.
And that's probably for 5 years.
Yes. And you're just talking about how the past 50 years, the average in that sort of safe money was, what do you say, 6.22?
6.2%.
6.2%. And now we have banks bragging about a 1.9 for 5 years.
Correct.
Crazy.
That changes the whole dynamic of the stability of the 60% in stocks and 40% in bonds for safety and how those things work together. If your safety isn't earning any interest, then you can't live off of that income in retirement. So you have to then rely on your stocks portion of it, the 60%, to do a lot more work.
And you start bumping that up.
And then what do advisors do? When you start to look at your statement, you're like, the stock market's going up. Well, you're either going to yell at your advisor because they're not earning enough compared to what the stock market's going to do. So your advisor is going to just bump that up. And what unfortunately, many financial advisors are doing right now is they're changing the conversation from this diversified 60-40 portfolio that has worked for the last 5 decades to maybe a 75-25 or an 80-20, meaning 80% of the money in the stock market, 20% of the money with stability. Those two things don't work in the same way as this 60-40 portfolio. You're adding a ton more risk and volatility when you start ramping from 60 to 75 or 80%. And what we talk about all the time, Matt, is that volatility in retirement. What you're doing is you're adding more and more opportunity for losses to really affect your retirement income and your retirement savings, because as you start to pull from these things, you save the money to use in retirement.
And keep in mind, the 80-20 that a lot of advisors are moving to, you're not 35 years old anymore.
Correct.
You are approaching retirement. You're 55, 60, 65 years old. And right now is when we're in this economic environment where the traditional 60-40, as far as the 40 being an average of a 6.2% return, it doesn't exist anymore. So if they're telling you now, let's look at the 75-25 split or the 80-20 split.
Yep.
Maybe if you're 35, that would work, but in 65, you're in trouble.
And in certain years, it might look great on your statement, meaning 80% in equities or 75% in equities when you're 70 years old or something might look great on years where the market's going crazy. Maybe in 2020, 2021, that might look fantastic because all of a sudden you just earned 30% on your money. But what you did was you took a ton more than 30% risk. Because when you start to have a risk-adjusted return and look at everything on a go-forward basis, that 80% in equities is too volatile for the vast majority of retirees and savers that have saved that nest egg, that if it can go up 30%, it can probably go down 50. So we need to look at what the risk is to earn these great returns. And are there other opportunities do we have to look at? So the whole structure of this conversation is, well, great, you're telling me that what has happened for the past 50 years was fantastic, but if I'm looking to retire in the next 5 years, what are my options, guys?
Right.
So this whole conversation was set up to, we have to rethink how we look at this diversified allocation, how we look at the stability and balance of our investment portfolio going forward. And what does the new 60-40 portfolio look like? And we have some thoughts on that.
And instead of going the 80-20 route, Nick, because a lot of people are like, well, my gosh, there's got to be a better way. I don't want to do that 75-25 split because I don't like that risk.
Got to be some options.
I don't want to do this 80-20. What can I do to keep me around that 60-40 split? Well, then that means there has to be an alternative for the 40.
Correct.
Because the 40 is your safe money, your safe income side. There has to be a change in that 40. And there's ways that you can do that. We actually discussed one earlier in the show whenever we were talking about the new opportunity for the up to 3.1% on an annual basis with that product that we were discussing. There's a way right there.
Correct. We have to start looking at unique or other alternative investments that are still very stable, but don't act and react the same way as the traditional 40% bond portfolio. What we want, and we talk about it all the time, Matt, is in retirement, and for most people, but especially in retirement, when time is not on your side and market volatility can impact you greater than at any other time in your life, the best offense, the best return possibility is having a great defense. They talk about that in football and basketball and sports all the time. We just had the NCAA Final Four conversation, I think, last show, Matt. Same thing with investing. When we think about it, we have to mitigate, we have to lessen the opportunity for tragic losses, tragic downturns in the market. And when we're at all-time highs right now, that's more of a risk than ever over the next 5 years, is there's going to be a pullback. So we need to start looking at other alternatives for that stabilizing factor, for stabilizing your returns, and then also being able to turn that into income that you can utilize in retirement. So not only will it stabilize your returns of market volatility, 60% in stocks going up and down a little bit, but having that good defense to cooperate with it, to supplement it on the other side for that 40, and then having the flexibility and utility to turn that into income that you can use, that's when we got to start looking at other options.
Absolutely. And just because you are being told, okay, you cannot do the 60-40 because the 40 is so bad, right? We got to up that 60 to 70 to 80. What if you could keep it at 40, but just change up the 40 and how the 40 is utilized?
Correct.
That you can absolutely do that. And we talk about it on our show almost every single time. And we talk about that safe money when we talk about the 3 C's of retirement, the checkbook, the calendar, and the clock.
Yep.
And how you have to stabilize that side of your retirement first. So then you can then jump into the equities like you talked about and the stocks and whatnot. But really just taking away all of that safety just to try to chase gain in the market is a dangerous opportunity that you can put yourself in when there's alternatives where you don't have to do that.
Correct. And advisors don't want to do it. It's the only way out there that they feel that they can get the returns that you want and you may need for your goals, needs, and objectives, is to get more and more risky, add more and more of the equity portion to your investment portfolio when there is alternatives out there. You got to look at who's managing that fixed income or that bond portfolio, how they're managing it, what other bond managers or alternatives are out there to manage that, maybe take some of that risk on them where they insure that bond, make sure that you get and or have the ability to maybe stabilize it where you're not going to lose, but have some opportunity to earn higher and higher interest rates if the markets cooperate.
And then maybe turn it into an income stream.
And then having the ability to then take that stability and turn that into utility, which we say income, cash is king, being able to have money that's going to come into your checkbook on the right day of the calendar, and then at the right time with the clocks, our 3 Cs. We need to have those things, and we need to look at other alternatives. The classic 60/40 portfolio for the majority of your retirement investing is not going to work the same way for the next 25 years as it did for the last 50. We're more concerned right now of rising rates, which causes bond prices to fall. So if you have 40% in bonds and rates are rising, inflation may be happening, rates rise to meet it, then your bond portfolio, your 40% is losing value.
Is going to
drop. So we need to look at other ways to add stability, because we still think that diversification and stability of that retirement plan, investment plan, and income is key. We just got to look at other alternatives to figure it out.
And it's important for people to understand that it can absolutely be done in today's economic environment. Just give us a call at 888-228-8814. Again, that number is on our website, 888-228-8814. And if you want to go ahead and fill out that discovery process with that orange button that we talked about in the top left of our website, that will also help us determine kind of where you're at with your 60-40 split or 80-20, whatever it might be.
That's a great point, Matt. The 60-40 is kind of a blanket example. It's a generic example for most people, and many advisors utilize it as a baseline. For one family, it might be 65-35. For another family, it might be 50-50. But 60-40 being that stable investment for long term, through the discovery process, that's when we can get into your specific family portfolio, what that overall holistic look is, and then we get really detailed into what that portfolio looks like for you to reach your needs, goals, and objectives.
You've got mail.
Now let's jump into the Income for Life question of the day on our IFL mailbag, Nick. And we got a really good one today that came out of Chicago that actually kind of ties in a little bit to our topic that we were talking about, how people could be flirting with disaster in retirement. And this question is from Andy in Chicago. And I'm going to read this to you, Nick, and I want you to answer it and tell me how this lands on you here.
Yeah.
Andy in Chicago, he says, how much of my portfolio is it okay to have invested in just one stock? I have about $2 million, but almost half of it is invested in one company. So first of all, Andy in Chicago, congratulations for having about $2 million in your account. And thank you for submitting your question to the Income for Life show. But I can absolutely kind of guess what you're going to be saying, Nick, here to Andy as we move forward. So go ahead.
Yeah, thanks, Andy. Thank you so much for sending in the question, and also thank you to everybody else that sent in questions. We chose Andy and might choose you next time because we think this one kind of fits along with the conversation that we were just having earlier in the show. And for Andy, the one thing that we don't know, which dictates a little bit of how we would answer this, is we don't know Andy's age.
Correct.
So, and we don't know if
huge.
If he's still working and all that kind of stuff. So obviously, anytime, and Andy's probably feeling it right now, he feels that he's got too much concentration, which is why he's asking the question.
Yeah, he asked the question for a reason.
He's probably feeling it. Maybe that one position, that one company has started to get a little volatile. The stock market isn't moving in the way that he wants it to for that one position.
Or Andy's getting older and he realizes he needs to diversify out a little bit.
But this is very, very common for people, especially if you're working and your company allows you to buy stock options and allows you to invest in the company. You're working there, you're making things happen, and the company's growing. You want to grow with that company because what you do every day helps that stock price go up, which is fantastic. And if you're younger, that can work just fine, and you might have a large portion of your investments in that one concentrated company position. But as we get older and as we approach retirement, if this plan or this investment allows it, we would always say, Matt, that we need to start to diversify that to get maybe not into the 60-40 portfolio of old, but start to gradually bring back some of that return, some of that concentration, open that up a little bit, get into a more broad-based investing and product approach to it, and start to bring in, well, when are we going to need to use this money? How are we going to utilize this in retirement? Still have some opportunity for growth, but get out of the risk of one company crashing or it dropping or it not getting the contract that it wanted to get and causes the stock price to go down, and all of a sudden In this thing, your $1 million in that one stock goes to $500,000 or $200,000,
whatever the number
whatever
might be.
it may be, and you just lost a bunch of money. Take the gains off the table if you have the opportunity to do it in your plan. If this is just you investing in one specific company in a brokerage account that you have, then you have the flexibility in that to start to unwind that concentration, open it up, get more diversified, and we're happy to have that conversation with you individually as to what that diversification could look like for you, Andy, on a go-forward basis, because what you want to invest in might be different than me or Matt, but we can set that plan together and maybe start to alleviate some of that risk that comes with having that deep concentration in one thing. And to end it, I just wanted to congratulate Andy.
Yeah, absolutely.
On a fantastic investment portfolio.
Great job, buddy.
Of $2 million. And, hopefully that one stock has done really, really well. And you obviously know what you're doing, but you're starting to feel the pressure of having a lot of it in one thing. Let's start to have a conversation of what that looks like.
Which is why we're of the view that's why he sent this question in to us. And
Correct.
if you want to send a question into the Income for Life show and have Nick and I have an opportunity to answer that on the air for you, just simply email that to us to info@incomeforlife.org, and we'll do our best to review those and answer it on the show for you like we did here for Andy in Chicago. Again, that email address is info@incomeforlife.org. And we want to wrap up today's show kind of like we often do. We always start talking about things that are kind of going on in the sports world out there right now. And there's always some neat things that are happening. Obviously, our Kansas City Chiefs are obviously not playing right now, but they're coming.
Baseball season,
but
golf
we got
season.
Baseball season, and we got golf that's happening right now. So our Kansas City Royals are actually playing pretty well, playing some pretty good baseball right now. I know it's early. I think they're only like 4-3 or something like that.
Yep.
But seeing people in the stands, seeing people out in the sun enjoying a baseball game or at like the Masters this past weekend, seeing the crowd was amazing.
Seeing fans at the Masters was really neat. It was very weird when they held the Masters in November and it was empty.
Yeah, completely different.
Completely different, but seeing the emerald green of the Masters, and they do such a good job of broadcasting that and seeing fans and hearing cheers, it kind of brings things back to more normal, and that's what we're excited about, and we're excited about it in the future, and hopefully wherever you're at and listening to this, things are starting to open up and things are starting to get back to normal. You can maybe start to see some family members and friends that you haven't seen in a while, and things can start to look brighter as we look forward.
Absolutely. And just the whole idea of being able to get out in the sun and be around other people at a ball game like we're talking about, going to see our Kansas City Royals play a game and being able to sit there on a Sunday afternoon and enjoy the day is something that we just have not been able to do over the past year.
Yep.
And people are now starting to get, the vaccines going. I know, Nick, you and I have got our first round of it.
Yep.
And a lot of people are doing the same. I feel like we are kind of on the cusp of getting through this.
Yes.
And
It's
I can absolutely tell. So wherever you're listening out there today, we hope you're feeling the same way. Hopefully we gave you some good information today as we discussed our topic about how we can maybe help you not flirt with some disasters in your retirement. Of course, we have our new IFL discovery process that we will absolutely recommend everybody take advantage of, as well as the link for the up to 3.1% return on your fixed money. So we gave you a lot of information today. We hope you enjoyed it here on the Income for Life show with Matt and Nick, powered by Folds of Honor. Thank you very much for listening to us today. And until next time, bye-bye for now.
Thanks for listening to the Income for Life show. If you have any questions about something we talked about today or want to get in touch with the Income for Life team, give us a call to 888-228-8814. That's 888-228-8814. You can also go online to incomeforlife.org and check the description of today's show for any relevant resources and contact information. You can also find the podcast on all major podcasting apps, including Apple Podcasts, Spotify, Google Podcasts, Stitcher, and many more locations. The Income for Life show is powered by Folds of Honor, a 501c3 nonprofit organization dedicated to providing educational scholarships to the families of America's fallen and disabled service members. For more information, visit foldsofhonor.org. Information provided on today's show is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified professional before taking any action.